Well, welcome everyone to the Clear Vista Financial Perspectives September update. This is where we kind of review what happens in the market over the previous month, talk about any predictions we have going forward. To that, I'm joined today for today's presentation by fellow financial advisor Jesse Hamilton.
Hey. Welcome, everybody.
We're glad you've joined us, or maybe you're listening to this a little bit later on. Jesse, why don't you go ahead and tell them what we're going to be talking about today?
Sure. So today we're going to talk about our main indexes for the month of August. Then we'll make our comments on the markets and about the current state of the economy. And we'll also have a detailed discussion, as we did last month, about the potential for an upcoming recession. We don't know if that's going to happen or not, but we want to make sure that you know about our new and improved way of interacting with us. So we can receive questions or comments to info@clearvistafinancial.com, or you can text us 254-282-0495. That's for people now, later, anytime you have a question, please shoot us a message. We would love to hear from you.
Great. And I think, Jesse, that I'll go ahead and turn the camera off so people can see.
Sounds good.
Have a little more video space for the slides and things. And we'll go ahead and let's jump right in. How the markets do this last month?
We'll start off with the S&P 500. This is the large cap index, cap weighted in the United States. The index closed minus 1.78 during the month of August, but you can see this V shape here. Each one of these, we call them candles, represents a day during the month. And you can see that the first 2.5 weeks, the index fell 5.64%, but then it rebounded. That's what we created the V shape there, Mark. So you'll notice the last candle of the month is what we call a gravestone here, which can be a weakness indicator. And the index is actually down since the end of the month.
Yeah, and when we see things like that, you know, one candle, one day's candle does not dictate the future. You'll see some other trends going on here that we get into a little bit later on.
Right.
But August, you know, was not as favorable as we had hoped. After coming off a strong July, the market did retrace somewhat, had a little bit of a rebound, but we'll have to watch in the coming months because September is typically a flat to a slight decline month almost every year, year in, year out. And this year right now is starting out as a typical type year.
So next is the NASDAQ, which is our tech-heavy index. Of course, heavily influenced this year by the Magnificent Seven, as they've come to be known as. But it did start to show some weakness in August. It had this similar V shape with the bottom there on August 18th. So the index fell for the first few weeks of trading. That was an 8.41% decline. And then it rebounded after that. So investors are still kind of shocked to see their quote magnificent stocks decline, but it might give some concern to how long this AI rally, or whatever you want to call it, could last.
Okay. What about the Russell 2000? This represents small cap.
So these are small cap companies in the US, and this index closed minus 5.11% during the month. So this is the biggest decline during the first few weeks, just like the other indexes. It had a 8.62% swing during those first few weeks, and then it bounced. The low on the 25th of August there is very similar to June and July. So we're going to call this a support line for this index. The index does tend to be volatile, so we'll be sure to watch it closely over the next few weeks.
Yeah, and we want to see strength in that small cap index because that signifies a broad-based rally, and we have not seen that. We continued to see the small cap struggle this year to rebound like the large caps have, really that Magnificent Seven. And by the way, did you watch that movie this last month?
I did not. It's on my list.
Okay, all right. For those of you that are a little bit older than Jesse, you all know the Yul Brynner starring in the Magnificent Seven. I think that was made in 1968.
Wow.
So, but we're seeing some similarities to 1968 here in this last year or so. So let's, what about long-term treasuries, Jesse?
So this is the long-term treasury index. It has a little bit different chart pattern. The index closed down 3.41%. and it did fall as much as 7.62% from the open to the low on 8/21. So this is a pretty volatile pattern for an asset class that many investors look at as stable, right?
Yeah, and you know, a lot of folks have come to believe over the last 40 years that, you know, having a 60% stocks, 40% bond portfolios, you're going into retirement is the way to go. But we've had a period of very low interest rates, and now we've had a period of high interest rates. Those bonds may be paying a higher yield, but there's an inverse relationship between the yield on the bond and the price of the bond.
Right.
If you were holding long-term treasuries last year, they lost value in many respects. At one point, the long-term treasury index was down 40% last year, and it's still struggling a little bit this year. So I think the long-term treasuries are flat year to date, but that's an interesting trend nonetheless.
Right.
So although there's a lot of people that are bullish on bonds because they're expecting that the Fed will cut interest rates any day now, but they've been saying that for about 2 years.
Right.
Okay, let's look at some long-term trends, Jesse, because I think this is pretty interesting.
Sure. So here's a 2-year look back at the S&P 500, and you can obviously see the calamity that happened last year and the volatility that investors have been facing ever since that low in October.
Yeah, and a lot of people, we've had people call up and say, hey, you know, the S&P 500 is up X, and they're wanting to know why certain things in their portfolio aren't up X. The reality is it's been isolated to 7 companies, but this is really telling. We are 2 years out from this high in August of 2021,
which is not the all-time high.
which is not the all-time high, and we still are below that right now 2 years later. This kind of reminds me of the lost decade in the 2000s, Jesse, where if you had purchased the S&P 500 in March of 2000 and looked 13 years later in March of 2013, the price was almost exactly the same. Even though you had lots of roller coasters in between, the index had not moved anywhere. So we're still a long ways of working our way back to previous market highs. And this is going to be a long road. You can just look at this graph and see the volatility here.
Right.
So let's look at the NASDAQ index. Similar pattern, right?
Right. Same chart here, but this one goes all the way back to February of 2021.
So more than 2 years, almost 30 months, have we not seen the NASDAQ index recover to that level. So we're a long ways from the highs. I think I looked, we're still about another 15% from the all-time high back in November of 2021. You know, this is really impressive. It shows the impact really of the aggressiveness of the Fed's rate policy and how it directly affects these tech companies who tend to borrow more to promote growth. We've talked about this on previous broadcasts. You know, higher interest rates affect tech companies, affect tech companies a little more. What about the relationship, Jesse, between growth stocks and value stocks? These are two different types of approaches people will consider. Tell what's going on there.
So this is the comparison between growth and value. They're always in competition with each other, kind of an arm wrestling match, if you will. When the line here, the black line, is trending up, that means that growth is winning. And as you can see, the month of August, there was a shift to growth again after really no clear winner for June and July. Yeah,
and this is just a relationship. This is not saying that growth is making money and value is not. Right. That does not indicate that at all.
It just both be going down at the same time.
Yeah, and this week they both have. But what we're looking at here is I'm having to compare two different types of asset classes where it's a growth stock or a value-oriented stock. Growth has been winning since really May. That's when we had crossovers in the moving averages, and that strength has recovered there. Like Jesse said, does not mean that they're making money. It just means that if I'm comparing two different types of asset classes, the growth is outperforming the other. Okay. Right. Well, let's jump into an economic update, and we'll talk to some other questions here in a moment. But remember, you can text your questions to 254-282-8255. 0495. That's during the broadcast or anytime for that matter.
Right.
And then also you can email us at info@clearvistafinancial.com. We will respond to your questions on today's program, or we will get back to you shortly. All right, jumping right in, Jesse. Why don't you talk about real GDP growth?
Sure. So real GDP growth in the second quarter was revised lower to 2.1%. That's an annual rate from prior estimates and from the consensus of 2.4. So this downward revision affects inventories, business investment, net exports, and there's an interesting relationship here between inflation and GDP growth. So what we call real or nominal GDP growth is the real GDP plus inflation. And that number was also lowered, 4.1 annualized compared to the prior estimate of 4.7%. This might not be exactly what people are thinking or expecting, but with GDP increase or decreasing and inflation slightly decreasing, that's where we get that number from.
Yeah, so there's a difference between nominal and real. Nominal is what investors are actually paying in this case of inflation. This is the real inflation.
Right.
But if you look at GDP growth plus inflation, you're looking at that higher number. That's the real number. And that was revised lower as well. So
they both were.
We expect that these declines in corporate profits to continue because we've got to get back to normal. We had this massive amount of fiscal and monetary shocks in 2020 and 2021, and that's going to be a headwind for equities going into the new year. In addition to corporate profits, we also got a second quarter total for real gross domestic income. It's an alternative that some economists will look at relative to GDP.
Mm-hmm.
Real gross domestic income grew at only a 0.5%. That's 0.5% annual rate in second quarter, and is down a 5.5% versus a year ago.
So it's not keeping up.
That's not keeping up. It's consistent with underlying economic weakness.
Mm-hmm. Now,
these are figures that are normally seen in and around recessions. We're not going to know that we're in a recession until the Bureau of Labor Statistics says we were in a recession last quarter. We may not see, and I'll get into this in a moment, we may not see hard data that says we're in a recession this time. I rarely say this, but this time it may be different. I hate to say that. We'll get into that in just a moment.
Yeah, August is when it pays to be a Fed member, though, right? You get to go to Jackson.
Yeah, you get to go to Jackson Hole and hang around and hobnob with all the central bankers from around the world. And if you recall last August, in August of 2022, Chairman Powell, chairman of the Federal Reserve, had a press conference. He dressed a little bit nicer this time. Last year, he was wearing his nice Western sweater vest, and he prompted the markets to fall further because he said, hey, wait a minute, we're serious about fighting inflation,
right?
And we'll do anything we can to beat that. And this time around, he gave a little bit more passive response in his normal press conference. And he argued for holding interest rates steady for now. But he did keep the door open to raising them later this year if the economy doesn't slow enough to keep inflation declining.
Mm-hmm.
Now, we're going to watch this, and we're going to show you some things of how we think this is mirroring the late 60s, early 70s, and early 80s. His address at the Kansas City's Fed's annual symposium underscored how he's trying to thread the needle. I mean, this is so precise, and rarely do Federal Reserves get it right.
They're trying to thread the needle with a hammer.
That's right. And they're trying they want to restrain the economy enough to reduce the price pressures without throwing it into a needlessly severe slowdown. In that meeting, Powell twice said that they would proceed carefully. If any further moves signaling he saw the little urgency to raise rates at the central bank's next policy meeting in September, which is coming up the week of the 18th.
Right.
So anyway, we see this, and I'd love to go to Jackson Hole sometime in the summertime. But anyway, so it's usual on this program that we talk about the Treasury yield, and this is a curve that shows the treasury yield at the end of the month, where you see short-term bonds, 1 month, 2 month, 3 months, we call those T-bills, are paying higher yields than a 30-year mortgage or a 30-year bond or a 10-year bond. And this is really important. It's still inverted. I think I've said many times, we look at, I'll see if I can draw on here.
Yeah.
Jesse, if I can get my drawing tools to work today.
We want this trend to look like a hockey stick, where the 1, 2, 3 month T-bills have lower rates than the longer term.
Yeah,
that's a healthy curve.
Right. I'm just gonna draw a little line and follow my cursor here. We want that curve to look something like a hockey stick, like Jesse was saying. You know, we see that, and we want that to be higher on the longer end with this, but not as much on the lower end. And did I jump ahead?
Yeah, we want to slide ahead. Let's go
hold
back.
on. Let me go back here. That's why I let Jesse drive the computer. You know, we've said this many times this year, starting this year, really, that an inverted yield curve like this has proven historically to be a precursor to a recession. In every recession in the history of the United States, the yield curve has been inverted beforehand. Now, a lot of leading economists that control the headlines continue to say this one's different. We're just going to have to wait and see what happens on this.
Mm-hmm.
I think in some ways they're different, because I think the government is measuring economic data in a different way. And this started with the Obama administration, where they started changing the definition of what's included in inflation.
Right.
What's, what really are consumers paying? They've also started changing the way that we see employment calculated and so forth. But the main point is here, you see that 4-month yield is around 5.6%, and the 30-year yield's around 4.2%. And the 10-year rate is closely related to borrowing costs for the American consumer. This is
for
lower
cars and whatnot.
Yes, but it's
credit.
much higher than it was even at the beginning of the year.
Mm-hmm.
So this is really going to be things that are continued to affect consumers and the economy in general. I think we'll continue to see a slowdown. We saw a little bit of that, and we'll talk about that in just a minute.
Yeah.
So this is the end of 2022, right, Jesse?
Yeah, exactly. So I just wanted to show the difference here, mostly in the short-term treasuries, 1, 2, 3 month. You can see the rates nearing 4%. So
right. So look at that. I'll go back. Here's the end of the month. Here's at the big end of 2022.
Yeah.
So short-term yields have really spiked.
Right.
And that is, a precursor to some things where we see that the yield curve continuing to invert.
That's right. And it's a positive thing for maybe your high yield savings account, but that's just about the only good thing.
Right. Okay. This is from the Wall Street Journal. Every month we look at employment data, and hiring slowed this summer, and unemployment rose in August. Now, normally that would be a bad thing or not a good thing, right? We don't want unemployment to go up, but that's the type of data that the Federal Reserve is looking at when they're talking about interest rates. They want to see that labor market start to cool. And in August, or excuse me, July, no, it's August, right? Employers added 187,000 jobs. You know what, folks? We could get the data from September, and the August numbers could get revised back. I don't really trust a lot of data coming from the government these days because of the way they're measuring things. And then we also have the risk out there that United Auto Workers are going to strike here in the next week or so if they can't reach a deal with automakers. And that's not, usually it's just one manufacturer that has the strike. This time they're threatening to do all 3 majors and strike at the same time. That'll put a dink in a lot of different things, but we're going to watch that very closely. So over the last 3 months during the summer, 150,000 jobs were added monthly on average. Now that's down from an average of $238,000 jobs as the average gain from March through May. Now, this is good data for the Federal Reserve because they're looking to see that employment growth to cool. There's still a lot of open jobs out there. And there's still fewer and fewer people that are looking for those jobs. So it's not going to raise the debate here. It's not going to really change the debate. It's not going to resolve the debate, I guess I should say, so whether or not they'll raise rates again in November, December. But I think that possibly for September, the Fed might pause with this. Now, other data out there shows that the broader economy remains strong, Jesse.
Right.
And consumer spending is surging again. And you're seeing a little bit of inflation data. Now, one thing we mentioned in the last month's program, the October numbers for inflation are going to change dramatically because of the way that the Bureau of Labor Statistics calculates inflation.
Right.
Those recent payroll increases are far below the roughly $400,000 monthly average gain in 2022. The unemployment rate, rose, like we said, 0.3%, and that's a big move considering, and that's just really, I think, Jesse, reflecting that more Americans are entering the labor market. You have a lot of college grads and things like that.
You mentioned that spending is surging during the summer, but we'll talk about here in a moment how spending might be up, but people's cash balances are not up.
That's right. So are we really headed for a recession? I don't know. Now, a lot of economists that we trust and think have a good balanced approach. They don't have a political agenda. I've been disappointed with some economists because they have you'll see it come out that they'll have some type of political agenda. And that's unfortunate. And I think that we just have to continue to watch this. There's a lot of mixed messages, if you will, of data that's pointing to a recession or saying, well, if it's not now, it's maybe a little bit later on. And that's the way to look at it. But let's talk about some things here that might be impacting whether that comes to fruition or not.
Yeah, nobody wants to talk about this here in terms of dollars, right? We all know that it happened, but here's the actual dollars that were poured into the economy.
11 trillion. And, that was the CARES Act, the CARES Act 2, the American Rescue Plan, the infrastructure plan, which they still have not spent hardly any of that because they put so many restrictions on who could actually use the money.
Right.
And then the Federal Reserve bought a lot of bonds to put about 5 trillion into the economy as well. So $11 trillion. Now, that is about almost three times the amount of money that's in our normal fiscal budget for the United States.
Yeah, that's
okay.
A lot.
So that was a lot. And another way to look at this is simply by looking at the Federal Reserve economic data online. You can go online and do this. This is personal savings rate. And the gray area that you see here is the kind of the very small recession.
The COVID recession.
The COVID recession, which was artificially induced when everything shut down.
Right.
But you see the personal savings spike. I guess if you can't go anywhere, you don't spend as much money.
That's
maybe.
Right. Well, you're not going anywhere and you're getting an extra paycheck or two from the government.
Right. And that was a big stimulus check. And you saw that fall and then spike again with some of these subsequent acts by Congress. But now you've seen that, and really our savings rates are below where they were before the pandemic.
Right.
This is concerning because people are spending more and more, but their savings are dwindling. That can only mean that they're also borrowing more. I don't think we've got a slide on the credit debts that have been rising so fast. We'll have to do that next time.
Yeah.
So here's a historical chart going way back to the 1985, and it's the Consumer Price Index. This helps us kind of determine how is inflation affecting the American consumer. Now, the blue line is total inflation, and the red line takes away food and energy. This is one of the changes that they made in the Consumer Price Index a while back because, food and energy are really volatile, and we shouldn't include them in the overall price index,
which I have so many problems with because I had to drive my car to get here today.
Exactly.
And I had to eat breakfast.
Okay. So if we don't want to eat and we don't want to drive our car, then inflation's kind of tame,
right?
Relative to what it was this time last year. But we all know that those are things that impact us. So although the Fed is concerned with core inflation, which is the things without food and energy, we really think you got to look at overall inflation because we can't deal without eating and we can't deal without having gas for our car.
Yeah.
Even if you're got an electric vehicle, you still have to charge it,
Right. It's still energy.
and utility costs are higher too.
Mhm.
How does the electric company make the energy to charge your car? Well, they use fossil fuels.
Right.
They may use some renewable energy, but very little. It makes up about 2% of the total capacity
Right.
in our system. Or they might use, and here in Texas, there's at least one nuclear plant and so forth. So we're using, electric cars sound great, but you are still using fossil fuels, and they directly impact your ability to keep that car going.
That's right.
So this is the thing that this came from the Washington Post, and I thought was really interesting. We saw it last month and thought, we need to include this, because the blue line on here is how the consumer price index moved year over year as a percent change from the late 60s, mid to late 60s through really 83. Okay. And this recent inflation move really mirrors that. Now, this is what Chairman Powell, the Federal Reserve Chairman, is trying to avoid. You may remember back, if you're a boomer, or if you were a nerdy kid like I was and studied public policy and economics in the 80s, you remember that Chairman Volcker, who was Federal Reserve Chairman at the time, really wanted to cut interest rates because he saw inflation falling. And this is kind of where we are today as compared to back to the late 70s, early 80s. And what we're trying to avoid is that subsequent spike. They cut interest rates too soon. The economy heated up again. Inflation took off again. And that's what we don't want to see. We don't want to see those interest rates go back above 14% again. And that's something I remember my parents were having to, as two educators or public school teachers, they had to try to figure out how to afford a mortgage that was 14, 15%.
Wow.
Many of you remember that. So, here's another chart that talks about the household savings or excess savings. We're exhausting that. And we're starting to see that, consumers are charging more, meaning that at some point that's going to come to roost. They're going to have to pay the piper on that. And racking up debt, consumer debt, is a problem, because that card holder or that debt holder has to pay back that debt with after-tax dollars.
That's right.
If we start seeing shrinking jobs and unemployment going up, then that means people are going to be more and more trouble, unable to pay, and they may default, et cetera.
You notice just how smooth the line is from 16 to 20.
Yeah.
And then look what happens to it in 20.
Yeah.
It's just out of control.
I mean, yeah, thank the American taxpayer when you got your stimulus check. Or if you got multiple stimulus checks, because that's all it was doing is the American government was printing money to put it in your pocket. And the thing is like, we really didn't need that. The economy was still strong. If we hadn't shut it down, we did not need that stimulus.
Yeah.
So we've fallen below the historical trend, and that's a problem. And we can see how consumers are behaving. The money supply, we don't have a graph this month for the M2 or the money supply. It's shrinking, and more people are meeting their everyday needs with credit cards.
That's right.
So, Jesse, I know you're a big car enthusiast, and you like to follow classic cars.
That's right. Yeah, I just saw an article this week, and I was talking to a good friend of mine about how this is really affecting people at all income levels. It obviously affects the people living paycheck to paycheck or trying to actually fill their tank. But the people who are buying $30,000, $50,000 classic cars are seeing it too. There was a car my friend sent me that sold for $50,000 in 2021, and it resold in the same condition last week for $31,000. So all incomes are affecting, all the way up to the 1%. I know I've seen it affect my family. So
yeah, and we're not saying that we're seeing deflation in prices, but discretionary spending is drying up. So people are not willing to pay as much.
Right.
So, 5 years ago, there were probably a dozen models of new cars that sold for less than 20,000.
Right.
In 2023, there was only one. It was the rather Spartan Mitsubishi Mirage hatchback. I guess how much is a smart car? Those little tiny things that could be crushed at any
They
moment.
eventually, at one point, they were under 20, but I don't know what
They're not
cost now.
anymore. Okay. And this little hatchback, Mirage hatchback, accounted for about 5,300 of the 7.7 million new vehicles sold in the US.
Right.
So if you're willing to spend more than $100,000 on a car, there's actually 32 models that you can choose from. Now, we even saw the other day that Toyota is bringing out a very high-end luxury SUV that the Emperor of Japan drives. Well, he doesn't drive. I'm sure he has a driver, but that retails list and starts for over, was it $170,000 or 270? I can't remember.
It was 170, yeah.
170. So, but for the average American, paying off a new car at current prices demands about 42 weeks of income.
Wow.
That's according to data from Cox Automotive. That's up from 33 weeks of income before the pandemic. And so we all know used car prices spiked, right?
They spiked and they really haven't gone back down. The average vehicle still sitting on a lot for about 27,000. That's up 30%.
And part of it could be because of higher interest rates.
Right.
That's made the situation more difficult for buyers. The average new car loan has a monthly payment north of $750, and that's an average interest rate of 9.5%.
It's very high.
For used cars, that average is above 13.7. Now, remember, 2 years ago, I could get a used car loan for about 2.9%, maybe less.
Right.
And so, people are taking and extending out the term of their loans, and we know that's bad news because people want new cars or a new car to them every few years or so, and people don't keep those cars as long as they used to. And what we see, especially, we've seen this a lot when it comes to military towns and things where there's a lot of people that are pushing cars on new enlistees and new recruits to the military, and they end up trading in their vehicle and they're underwater of what it's worth versus what is owed. And so that's a trend that we see and not helping things for consumers. So Jesse, another way to look at a recession leading indicators is to examine manufacturing in the US. The ISM, the manufacturing index, increased to 47.6 in August, and that was beating the consensus of 47.0. Now, you may think that this is really great, that's improving, but when we see levels that are lower than 50, that means that the manufacturing economy is contracting.
Yeah.
Anything higher than 50 signals expansion, anything levels below 50 signal contraction. So activity in the US factory sector contracted for the 10th month in a row in August, although that was at a slightly lower pace. We're going to continue to watch this. And this is one of the reasons that we still believe there's enough things out there that we may have a recession lurking ahead. And today's report shows that the manufacturing sector is likely to lead that way. And it won't be just, will there be a recession? Yes, I think there will be. It may be further out in 2024. So as we wrap up, we don't have a definitive answer. And we know recessions technically are kind of bad. We don't necessarily want to experience that. That might mean folks have been laid off, and that's not good for the economy or people's pocketbooks. But we don't really know. And I think this time it is really different, not because there's something unique, American exceptionalism that's going on, Jesse, that means that we're not going to have a recession. I think that we have artificially created a situation that we don't, in the United States and around the world, that we don't know what's going to happen. We are unable to predict. We don't have a crystal ball. We don't have any experiences in the past that say, if you pump $11 trillion into the economy,
what's going to happen?
This is what's going to happen in the next few years. So, a phrase among our network of active risk managers over the past few years is we are living in a world with little or no historical precedent. And that's right. We do know that many of these conditions that we've talked about today have led to a recession 100% of the time, but that doesn't guarantee the outcome will be that way this time. Now, we might be able to claw our way out of the situation over time and achieve what the Fed calls a soft landing. And that's what they're striving for, but there's still a lot of headwinds that are out there are strong, both as an investor and a consumer. So as we talk to our clients, we tell them have patience because this is going to take some time to work through. Now, there will always be investments that that you can find that are outperforming others, Jesse, but there's not a lot of positive things that are going on within the stock market this month and this summer.
Right.
We started to see things, and I think you took that slide out, Jesse, that had the price channel in there.
Yeah.
So we can't show that. That's okay. But we're still seeing that the trend is up. It just may be really volatile along the way.
That's right.
So, folks, Jesse, as we wrap up, I'm looking for questions. I'm not seeing anything on the text line or in the info at Clear Vista Financial, but you can mail those in and we'll get back to you.
Yes.
You always want to encourage you to take action in your financial journey. We're always here for you to help navigate that world of financial planning and risk.
Right.
So, recession or not, please let us know if we can help, because you may have a question that your current financial advisor has not talked to you about, and we love to talk about it. And we love giving free advice.
Yeah.
But financial planning means being prepared for the unexpected things that can happen. We don't know the future. We cannot presume upon the future. But our strategies not change. We encourage you to check your statements, talk to your professional, educate yourself. And if you don't have a financial professional, we'll be glad to talk to you sometime about that as well. Jesse, I'm not seeing any questions on the board for today. So as an easy way, if you want to call our office, give us a call. You can click the Calendly link or calendly.com/Mark Trice, and you can actually just schedule a call.
Yeah.
I give people access to my calendar. I probably shouldn't do that, but I do, and we offer that complimentary consultation. But Jesse, I want to thank you for putting together our program today.
Sure.
And I want to thank our listeners out there for being a part of this event. And we hope to speak to you soon. Have a wonderful day.